Have you ever paused and asked yourself who really drives the gears of this economy? It's easy to believe the government sits in a distant tower, writing regulations and enforcing rules. But the truth is, right now, it's stepping down onto the field as a major investor. It's not just writing checks or issuing grants anymore. It's taking equity, demanding power, and reshaping how America competes. What you're about to hear may sound bold, but it's happening in plain sight. This is not financial advice. Imagine this. The US now owns nearly 10% of Intel, not through some vague fund, but via direct conversion of subsidy money into equity. The CHIPS and Science Act wasn't just about supporting a faltering industry. It was structured so the Treasury and Commerce departments could exchange capital for shares. Intel agreed to allow the government to buy more if it hits specific production and employment metrics. That means the government isn't just cheering from the sidelines, it gets a seat at the table. Then there's MP Materials, the only US-based rare earth mining company with meaningful scale. The Department of Defense stepped in by issuing convertible preferred stock and tying investment to supply and price controls. The result? Washington owns about 15% of the company and has a hand in pricing strategy and export policy. That's not philanthropy, that's influence. Lithium Americas got a similar deal. A $2.3 billion DOE loan wasn't just a loan. It came with warrants that give the government the option to acquire up to 10% of the company if the project succeeds. Investment in infrastructure projects like Trilogy Metals has followed suit. Build the access road, get a stake, secure long-term resource rights. If you want to do business with the US, equity might be your price of admission. Even in steel, the tactics are evolving. When Nippon Steel tried to acquire US Steel, the White House intervened and demanded a golden share, a non-economic equity vehicle that gives the federal government veto power over big decisions like plant closures, foreign ownership, or executive appointments. It doesn't earn dividends, but it wields control. These mechanisms, convertible instruments, loans with warrants, infrastructure for equity, golden shares, are reshaping how government capital flows into private enterprise. Instead of just writing checks, the US now asks, what's my return? And how do I influence the outcome? And when it's partly on the hook for profit or loss, regulation becomes much harder to pull back. The government stops being referee and starts being co-owner. There's a powerful rationale behind this shift. In a world where China dominates rare earth refining, lithium processing, solar panel manufacturing, and a host of emerging technologies, the US no longer has the luxury to stay on the margins. China can throttle exports, manipulate prices, or weaponize supply chains. If we don't own parts of those supply chains, our leverage shrinks. The question is, do we accept globalization as it is, or do we fight for sovereignty? By acquiring stakes in Intel, in mineral extraction and battery supply chains, in energy infrastructure and steel, the US is creating a strategic hedge. It's betting that owning critical nodes is as important as building new ones. It's protecting future industries from being hostage to geopolitics. It's saying that national security now looks like partial national ownership. But this path is fraught with tension. Once government becomes an investor, it cannot avoid influencing markets, management, or capital flows. That influence can become a tool for picking winners and losers. Which companies will be preferred, not because they deliver the best product, but because they carry geopolitical weight and align with administration priorities. That's a dangerous shift. History teaches us that when private enterprise and political power intertwine deeply, innovation can suffer. Firms may shift their focus from creating superior products to optimizing access to government contracts. They'll spend more time lobbying, navigating red tape, and appealing to regulators than improving efficiency or delighting customers. Over time, that distorts the incentives of capitalism itself. Companies with strong political connections may receive favorable financing, regulatory forbearance, or crisis insurance. Independent, scrappy competitors without ties to the government may struggle to keep up. That's not speculation. It's a pattern seen in many economies where state capital and rent-seeking dominate. Still, it's hard to argue the approach is naive. In an era where chip supply chains, battery minerals, AI infrastructure, and clean energy are battlegrounds of global power, a laissez-faire stance may simply cede the field to authoritarian rivals. If we leave it entirely to private markets, we risk critical technologies slipping out of our control. Buying stakes in these sectors may be the blunt instrument we use to assert influence. For investors, this shift radically changes risk and reward. Political alignment, strategic partnerships, and government backing may matter as much as balance sheets. Stocks partially owned by the state might enjoy easier access to capital, stability during downturns, and a built-in interest in longevity rather than short-term profit, but they might also carry regulatory baggage, scrutiny, or moral hazard. We may also see a new function in markets. The government could act as a stabilizer. In election years or crises, it might be less willing to allow its portfolio companies to fail. That could create asymmetry in risk. Government-backed firms could get lifelines others won't receive. At the same time, it's vital to remember that equity ownership doesn't guarantee perfect execution. Governments are not always nimble. They are subject to shifting political winds, bureaucratic constraints, and public accountability. Missteps, misallocations, or political capture remain real dangers, and the jobs narrative is overhyped. These industries tend to be capital-intensive and increasingly automated. A new semiconductor plant, a battery refining site, or a rare earth facility does not necessarily translate into millions of middle-class manufacturing jobs. It might mean thousands at most, but many of those will be tech or robotics roles, not bulk labour. So while these projects get ribbon cuttings and headlines, the impact on broad employment might be modest. Still, for long-term investors, this is a moment to recalibrate. The lines between finance, regulation, politics, and national interest are blending. The next decade might reward firms that navigate this nexus well, those that align with strategic priorities, maintain legitimacy, and deliver on both innovation and alliance with state goals. In effect, the US is constructing a new hybrid model, rooted in capitalism but informed by state oversight and strategic equity. We'll call it State Capitalism 2.0, if you like. It's not full nationalization, but it is a redistribution of authority in how markets work and how capital flows. For the everyday investor, this means reading between the lines. Watch which companies secure government deals, which have government ties, which sectors are deemed strategic. Those trends will matter. Don't just look at earnings and margins. Also look at contracts, regulatory alignments, and political risk. We're entering a period where public policy and investment strategy will increasingly overlap. The government is no longer a distant referee. It's halfway onto the field. That creates both opportunity and danger. If you can see it coming, you're better positioned to ride the wave or avoid the pitfalls. The US government buying into private companies isn't just a policy shift. It's the start of a new financial era where the old rules of capitalism are being rewritten in real time. Let's start with the why. Why now? Why is America suddenly taking ownership in companies instead of just funding them? The short answer, survival. The long answer, the old model doesn't work anymore. For decades, globalization was the playbook. The US designed, China built, and the rest of the world consumed. That worked when the world was stable. But now the global economy is splitting into two competing systems, one centered around the US dollar and another around Chinese capital. Both sides want control over energy, microchips, rare earths, and artificial intelligence. Whoever controls those wins the future. The US can't just regulate its way to victory anymore. Sanctions don't work on countries that own their own supply chains. You can't threaten to cut off China from something it already produces itself. So America's response has become, if we can't buy it, we'll build it. And if we can't build it fast enough, we'll buy part of the companies that can. It's a move that combines capitalism with state strategy, something that used to be considered off-limits in Western economies. But this shift creates ripple effects across every layer of finance. When the US owns a piece of Intel, MP Materials, Lithium Americas, and US Steel, Wall Street pays attention. Because if the government has money in the game, it has an incentive to stabilize those stocks. It doesn't want headlines about failures or bankruptcies tied to national security industries. And that safety net, real or perceived, can draw in more private investment. In other words, government capital becomes a signal to markets. This company is too strategic to fail. This brings us to a new concept that investors need to understand: state-aligned investing. In this world, the winning strategy isn't always about finding the most innovative or efficient company. It's about identifying which ones align with government priorities. Companies connected to defense, AI, energy, infrastructure, and semiconductors are all part of the new strategic economy. We've already seen this pattern start. Look at how AI companies tied to federal contracts, like Palantir, or defense tech firms like Lockheed Martin, have seen growing investor interest as national security and data become intertwined. The same thing is beginning to happen with green energy firms that receive government-backed funding or tax incentives. Investors know those companies aren't operating in a purely free market. They have a tailwind. But there's another side to this coin. When profits start depending on political favor, creativity can stall. Why spend billions on research and risk when you can spend millions on lobbying and influence? Economists call this rent-seeking, and it's a problem that's already visible in heavily subsidized industries. If it spreads, the US could find itself with slower innovation and bloated inefficiency, exactly what it used to criticize in other systems. So how do we find balance? Ideally, the government acts as a long-term strategic investor, supporting critical infrastructure but not micromanaging it. Think of it like a silent partner rather than a controlling shareholder. If that line gets blurred, markets lose their competitive spirit. But if the government keeps its role narrow, providing early capital, protecting key sectors, and stepping back once they're stable, it could actually make the economy stronger and more resilient. There's another dimension to this story: automation and artificial intelligence. Many of the industries now being protected are highly automated. Semiconductor manufacturing, lithium refining, and advanced steel plants rely more on robotics and AI than on human labor. So even though the narrative is about bringing jobs back to America, the reality is that most of the work will be done by machines. The benefit will be strategic security, not necessarily massive employment growth. That might sound negative, but it also opens new doors. If these industries thrive, they could spin off entire ecosystems of high-tech suppliers, engineers, and service companies. Think of what Silicon Valley became after early government and university research funding. The key difference now is that Washington won't just be funding that innovation, it'll be profiting from it directly. But as the government takes on more of a shareholder role, there's also more at stake politically. If a company like Intel underperforms or faces scandal, it's no longer just a corporate issue, it becomes a political one. Voters will ask, why did our tax money buy that stake? Politicians will have to defend investment choices. Markets will react not just to earnings reports, but to election cycles. The stock market will become even more tied to political narratives, especially in sectors where the government has ownership. For everyday investors, this means two things. First, we need to pay attention not just to balance sheets, but to policy direction. If Congress passes new funding for green energy, or if the Department of Defense announces new strategic mineral priorities, that's a signal for where capital might flow next. Second, volatility may shift. Government-backed sectors might gain stability, while independent ones could face more risk if they're seen as non-essential. What we're watching unfold is the early framework of a state capitalist America, where the free market still exists, but it's increasingly shaped by strategic investment from Washington. It's not socialism, and it's not pure capitalism either. It's something new, a hybrid system designed to compete with command economies without abandoning market principles entirely. The implications are massive. On one hand, this could lead to a new golden age of industrial strength, where America rebuilds its manufacturing base, dominates next-gen technology, and becomes self-sufficient in critical sectors. On the other hand, it could also centralize too much power, create inefficiencies, and shift innovation from the garage to the government office. Which way it goes depends entirely on how responsibly this power is used. But one thing is certain: the financial landscape will never look the same again. Markets that used to respond purely to earnings and performance will increasingly react to policy and geopolitics. Government press releases will move stock prices. Election outcomes will shape corporate valuations. The border between Wall Street and Washington will blur even further. For investors willing to adapt, this could be an incredible opportunity. Those who understand where the government is positioning itself can follow the flow of capital into new growth sectors before everyone else catches on. But it also demands caution. Because when politics mixes with profit, decisions can change overnight. So what does this all mean in practical terms? It means that the new investing mindset will look less like buy what's undervalued and more like buy what's aligned. Strategic sectors like semiconductors, clean energy, AI, defense technology, cybersecurity, and critical minerals are becoming the new pillars of the American portfolio. The US government has already made it clear it wants to own pieces of these industries. And when Washington decides something is essential, the money usually follows. We're entering an age where the United States is not just governing capitalism, it's participating in it. It's buying stakes, shaping direction, and redefining ownership. Whether that makes the system stronger or weaker will depend on how we handle it from here. But one thing's clear: the game has changed. If you found this helpful, make sure to like and subscribe.